Soldano. I'm president of Family Enterprise USA and Policy and Taxation Group. We're very pleased to have you join this webcast today. Family Enterprise USA promotes generationally owned family businesses and their lifetime of savings at a national level in Washington, D.C. We represent all families, businesses, all sizes, and all industries. I'm also president of Policy and Taxation Group, which represents family offices and successful individuals at a national level in Washington, D.C., working on tax and economic issues that affect them. So we're very, very pleased to have Brown and Streza host this webinar with us today. I'm very pleased to have a topic that I think is going to be very interesting to everyone on this call today. I remind everyone the call is being recorded. We will send this recording around to not only the people that registered, but to others in our database that might be interested in watching it at a later time. So the topic is philanthropic strategies for successful families. So you may be familiar with the statement, charity begins at home, but the complete proverb actually is charity begins at home, but it should not end there. This webinar will take this proverb and it will take it a step further by providing an overview of 3 common tools successful families use to organize and execute on their charitable goals. Brown and Streza is a firm located in Orange County. I think many of you know that. I've used Brown and Streza. They're an excellent, excellent law firm. They provide exceptional integrated legal services in the area of tax, estate, business and charitable planning, mergers and acquisitions, business succession planning, trust and estate administration, which a lot of firms do not provide, I will tell you, and real estate. They serve families, businesses, entrepreneurs, investors, philanthropists, and charitable organizations. So again, we're thrilled to have them on this webcast today, but we're also very thrilled to have them as a sponsor and support the work at Family Enterprise USA. Today, we have Casey Hale, who is a partner at Brown and Streza. His practice is focused almost exclusively on legal representation of organizations exempt under the IRS Code 501c3. Over the past 20 years, he's helped hundreds of family foundations, other private foundations, religious organizations, supporting organizations, and public charities successfully navigate the complex and unique rules that apply to exempt organizations. Also very pleased to have John Piper, who is also a partner at Brown and Streza, where he counsels a wide range of nonprofit and tax-exempt organizations with a particular focus on religious organizations. He advises for-profit and nonprofit clients on entity structures, corporate formation, and governance, charitable planning in business transactions, and charitable giving vehicles, including private foundations, supporting foundations, and donor-advised funds. So, John, Casey, again, very pleased to have you today on this webinar. And now I'm going to turn it over to you. The slides have already been shared, and I will advance the slides as you tell me you need them advanced.
Sure. Thank you, Pat. If you would advance to slide number 6, the agenda. I think that would be a good place to start. On the agenda for today, as a part of our presentation, we're going to basically cover 4 different areas with respect to the philanthropic vehicles that we typically see successful families use to advance their philanthropy. The first item that we're going to cover, the first area that we're going to cover, is we're just going to kind of take a high-level view at the requirements for these organizations to be exempt under 501c3, and then we're going to take a little bit of a closer look at these 501c3 organizations and how they're classified under Internal Revenue Code section 509A. So under 509A, there are different subcategories or different types of 501c3 organizations, and it's important to just have an awareness of the different types of categories of 501c3 organizations, because it's relevant to operating parameters, it's relevant to deductibility limitations in terms of tax deductibility, and other things as well. So, John?
And then we will, don't worry, it's not going to all be tax. We'll then give you an overview of the three vehicles themselves. You'll see we've alluded to them there: the private non-operating foundation, the type 1 supporting organization, and the donor advised fund. And we'll walk you through sort of the features of each of those, and some of the rules that apply, and how your family could use them effectively for sort of shared family philanthropy. And then we'll close out with some questions that will help us to assess the effectiveness of each of these vehicles and point out some of the differences from an operational standpoint. For example, which organizations can be under the complete control of the family versus sort of shared control with another organization or entity. Which organizations can employ one of your kids, if one of your kids really, or grandkids really is enthusiastic about the philanthropy, et cetera. So we'll spend some time on some of those issues at the tail end of the presentation. Next slide.
So when it comes to 501c3 organizations, or in other words, organizations that are recognized as exempt under 501c3, there are basically 4 requirements that have to be met. The first one is that the entity must be organized and operated exclusively for charitable purposes, or purposes that are enumerated under Section 501c3. And we have a list of those here. That they can be organized and operated exclusively for religious organization, or for religious purposes, charitable purposes, scientific, testing for public safety, though that's very uncommon, literary, educational, amateur sports, and then the prevention of cruelty to children and animals. And the idea here with organized and operated, organized really refers to a what's called the organizational test. And that really goes to the documents and how the corporate, or if it's a trust, how the trust documents are drafted and whether they have certain component parts in them. The operated piece here goes to the operational test. And there, in order to be exempt under 501c3, the organization has to operate exclusively for its express purposes. Now, typically, just one more comment before we go to the next slide. Now, typically, a 501c3 organization is not going to list all of these purposes. Typically, they will focus in on, one or maybe just several of these purposes. So it's not, a 501c3 doesn't have to operate for all these purposes. It can sort of select which of these that it would like to operate for.
And just to add one more note on that, charitable has been interpreted by the IRS to be a very broad category that can actually incorporate a number of these other categories as well. So there's a lot of flexibility with the charitable purpose. And as we get into discussing the private foundation in particular, as Casey mentioned, often you'll find a handful of these purposes stated to provide a broad range of purposes so that the organization can fund a broader array of organizations.
Next slide, please, Pat.
I'd like everyone to know that if they have a question as we're going through this, please put it in the chat. They'll be happy to take the questions. We'll also have time at the end. I know some of you did submit some questions in the registration, and we should be able to get to those.
Thank you, Pat. So I mentioned that there were four requirements. The second one is just that none of the earnings from the 501c3 organization can inure to the benefit of any private shareholder or individual. And this requirement encompasses two different doctrines, two different but related doctrines. One is the private benefit doctrine. The other is private inurement. Private benefit just prevents the organization from benefiting individuals that are outside of the charitable class. that the organization is focused on helping or serving, and private inurement is focused on, or it's a prohibition that prevents the earnings or assets of the organization going to anyone who is an insider, here sort of referred to as a private shareholder of the organization. Even though nonprofit corporations don't have shareholders, that's how it's set out in the code. But it really just means insiders with respect to the corporation.
So Casey, would a 501c3 exempt organization ever pay a dividend to directors or members?
They would not, but we are sometimes asked that question by clients. But no.
Thus my laughing.
So the third requirement is that no substantial part of the organization's activities can involve carrying on propaganda or otherwise attempting to influence legislation. And this really just provides that a 501c3 organization cannot be involved in lobbying or influencing legislation to a substantial degree. The final requirement is basically there's a complete bar on a 501c3 organization from using its assets or otherwise activities or otherwise becoming involved in a political campaign or getting involved with electioneering, especially with respect to a candidate for public office. So we do get this question fairly frequently as well.
And we can contrast that with what sometimes is referred to as issue advocacy. It is possible within certain prescribed parameters for a tax-exempt organization to advocate for particular issues, but it's a complicated area that would really warrant a completely separate webinar. So we're not going to address that in any detail here.
But I appreciate you saying that, John, because obviously that's exactly what we do at Family Enterprise USA.
Exactly.
Advocate for family businesses.
Exactly. Next slide. So as Casey alluded to, in addition to the question of tax exemption under 501c3, then there's this companion issue of how is the organization classified? And the two broad categories that you'll hear reference to is private foundation and public charity, or it's actually not a private foundation, but the not a private foundations we generally refer to as a public charity. And as we'll discover as we begin to go through the rest of this presentation, the private foundations are organizations that are generally under the control of a single family or a small group of people. They may be funded by a single person. And these organizations, because of being under the control of a single person or a small group, they're a little more susceptible to potential abuse. And so what we'll find as we begin to go through the rest of the presentation is that these organizations are subject to some more stringent rules than organizations that are supported by the general public, like Family Enterprise USA, like any number of organizations that you're likely familiar with, Big Brothers, Big Sisters, the Boy Scouts, a whole variety of organizations that we could think of, Meals on Wheels, et cetera. So the idea with these organizations is as I say, they're sort of under this small group of control. Relatedly, we're going to talk in this presentation about the private non-operating foundation. These are organizations that are focused primarily on grant making. So that's your typical family foundation, rather than being focused on actual charitable activities. So the kinds of foundations that we're going to be talking about are not the ones that are going out there and actually doing the distribution of food to the homeless, for example. They're instead funding an organization that's going out and doing the distribution of food to the homeless. If the organization were doing the operations itself, there's a special category of private foundations referred to as private operating foundations that are subject to a different set of rules different tax treatment, et cetera. That's kind of beyond the scope of this presentation because we're more focused on how can a family organize its charitable giving in this presentation. So the other side of it, the 2/3 of the pie that you see there refers to the not-a-private foundations under 509A. And these generally break down into two categories. There are organizations that are supported by the public. Typically, these organizations receive up to 1/3 of their support from the general public. And then there are also organizations, or at least 1/3, I should say, from the general public. And then there are organizations that, by definition, are considered public charities. These would be things like schools, nonprofit schools, nonprofit universities that have regular faculty, degree granting, a normal or regular student body. This would also be churches that are public charities by definition. Nonprofit hospitals. There are a variety of organizations like that that are public charities by definition. And then that other category that I mentioned, which are organizations that receive typically at least 1/3 of their support from the general public. And that can take the form of donations, or depending on the categorization, it can sometimes be public support that comes through the activity of the organization itself. An example of that latter category would be, for instance, if we were talking about a public charity that operates as a museum, and the admission fees that are paid by the museum can be deemed public support for purposes of that test. We're not going to talk a lot about the public charities because, again, these are the organizations that tend to operate. Instead, we're going to focus from a public charity standpoint more on the bottom slice of the pie, if you will, the supporting organization. This is a special category of organizations that are public charities for tax purposes by virtue of their relationship to another public charity. So, for example, if many of you may be familiar with the notion of a community foundation. So if you established a relationship between a foundation that you found and a community foundation in your area, it may be possible to structure it in such a way that it's considered a supporting organization. And supporting organizations are subject to or benefit from increased tax deductibility and are not subject to all of the same rules as the private foundation. And we'll, as we go through the balance of the presentation, we'll walk you through some of those benefits and some of the detriments as well. Next slide, please.
Okay, so in this next section of the presentation, we're going to spend some time talking about each of the three entities that we want to present today. So first, we'll start with the private foundation. And again, this is what we're talking about here when we're talking about private foundations in the presentation is a private non-operating foundation. And that non-operating really just signifies that the private foundation is focused primarily on making grants, on distributing grants out to other 501c3 public charities. So with respect to a private foundation or private non-operating foundation, it can be established as either a nonprofit corporation or a charitable trust. So that would be the underlying legal entity. And as we mentioned earlier, with respect to the 4 different general qualifications to be recognized as exempt under 501c3, it would have to operate for some enumerated or express exempt purposes listed under 501c3. With a private foundation, the funding typically comes from one person or one family or one company. The term family foundation and private foundation is somewhat synonymous in this respect. But the funding doesn't come from the public. It comes from typically one source or very few sources. A private foundation, as we're talking about it will be exempt under 501c3. So donations to the private foundation will be deductible to the donor. And then one of the other hallmarks of a private foundation is that It provides the ability for the organization to be controlled by the donor or by the founder. And that's much different than many of the public charities, because under the law that applies to public charities, in most instances, those public charities cannot be controlled by a donor or a founder. Rather, they need to be sort of controlled by the public. Just a couple comments I'd like to make about private foundations in terms of the number of private foundations in the United States. So an organization called Candid, it's a leading authority on nonprofit activity in the US. So they published a report in 2021 that showed that as of 2020, there were 99,578, so just under 100,000 non-operating foundations in the US. And about 63% of those had less than $1 million in assets. And about 29% were between $1 million and $10 million in assets. So what that means together, about just under 92% of all non-operating foundations in the US have $10 million or less. But I just thought that was interesting data, particularly that they found that there were just under 100,000 in 2020 of non-operating foundations in the US. So next slide, please, Pat.
So now we're going to talk about the Type 1 supporting organization. As I mentioned 2 slides ago, the Type 1 the Type 1 supporting organization, I sometimes jokingly refer to as the family foundation on steroids. The organization, as we'll discover as we move forward, gets some enhanced deductibility for charitable contributions, and also avoids the application of some of the stringent rules that apply to private non-operating foundations. But the way that it gets those benefits is by virtue of its affiliation with another public charity or with a public charity. And under the code section that applies, and here we're referring to 509A3 of the tax code, and specifically the subsection under that B and the first Romanette, if you want to get all the way down to the actual citation. But what that rule says is that the organization must be operated, supervised, or controlled by one or more public charities. So in my experience, I've seen organizations establish these supporting organizations in relation to, as I said, community foundations. There are some community foundations that will permit these relationships to be established. I've also seen them established with religious organizations, church organizations, and various other kinds of public charities. Sometimes these are public charities where their primary goal is the facilitation of philanthropy, like the Community Foundation. In other cases, they're public charities that have a particular operation, as in the case of the churches and religious organizations that I've seen do this in the past. But the way that they typically exercise this control, at least as I've seen them structured, is through the appointment of a majority of the board. It could also be through the appointment of officers, depending on the circumstances. But the more frequent structure that we see and that we utilize involves the appointment of a majority of the board. So typically you would have the donors, say you, if you were forming one of these organizations, perhaps you and your spouse would serve on the board, you would appoint yourselves, and then the charity would appoint 3 other individuals to the board. And there are ways to sort of work with the charity to identify who those folks are, but they ultimately have to be people who are not you or your family or a business under your control serving in those roles. So that's how you establish that control relationship with the organization. And as we move forward, you'll see why that would be beneficial. So we're talking about an independent charitable organization here. It would be its own corporation or trust, and it would have this affiliated relationship with the supported public charity, as I mentioned. It can still be funded by a single family or individual or a single company, even though it's a public charity. Because remember, its public charity status is not by virtue of the fact that it's getting its support from the public. It's by virtue of the fact that it's got this affiliated relationship. Still exempt under 501c3. And as we talked about, that supervision control, operation supervision control relationship that establishes the affiliation. Why don't we go to the next slide? I want to talk about DAFs, Casey.
Sure. So just to kind of bring us up to the current slide. So we talked about private foundations, which are private foundations. John just explained or gave an overview of a supporting organization, which is classified as a public charity. And now the third type of entity that we're going to cover today is a donor advised fund. And these are technically public charities as well. So it's in that category. So a donor advised fund, many of you may have heard of these. But so typically what a donor advised fund is, it's a charitable account that is set up at an existing charitable organization. In most instances, those what's called a sponsoring organization, it is a public charity, but it's a public charity that's devoted to facilitating, philanthropy, like a community foundation. A donor advised fund is not a separate, independent legal entity. Instead, it's an account that is set up by a sponsoring organization to which the donor can make tax-deductible contribution. The donor advised fund, or the DAF for short, is identified in connection, with the donor, and the donor has certain privileges with respect to the DAF. So in most all instances, the DAF will be able to recommend grants that the sponsoring organization will make out of the donor's DAF to provide funding to other 501c3 public charities. And then DAFs, or the donor advisor, or the donor, in many instances can also recommend how the funds that are held in the DAF are invested. But again, it's not a separate legal entity. Instead, it's an account at a sponsoring organization. Do you have any comments on?
Yeah, so the one thing I was going to say is, at least based on the same sort of 2021 data, DAFs, there are slightly more DAFs in the US than there are donor advised funds than there are private foundations. I think there are a little over 1 million donor advised fund accounts in the US. But these, the aggregate dollars that are in these donor advised fund accounts is somewhere around 100, just about 160 billion with a B. And I think the evidence of the growth of popularity of these, if we were all in a room together, I would say, does anybody know what the largest charitable organization in the United States is? And at least when I last checked, the largest is Fidelity Charitable, which is a donor advised fund sponsor. The second largest, Schwab Charitable, which is also a donor advised fund sponsor. These are extremely popular with individuals, especially individuals who are primarily giving cash or publicly traded securities because of their ease. It's typically as easy as opening a brokerage account, and then you can wire in your contributions, or if it's also where your affiliated broker can have access, they can help you identify securities to donate, etc. So there are a lot of benefits to the donor advised fund, but because it's not an entity, you don't get the same ability to exercise control that you do with a private foundation in particular, but even with the supporting organization, because it's not a separate standalone entity with its own board and its own officers. Although you can approximate those things by, for example, having your spouse and your kids also have the ability to view the donor advised fund account and make recommendations and things like that.
Yeah, John, I think your comment about there being slightly more DAFs in the US versus private foundations, I think that was made tongue in cheek, but just to make sure that that didn't come through clearly. So there's about just under, according to the study that I cited, just under 100,000 private foundations, and there's over a million, just over a million donor advised funds.
Sorry, thank you.
No,
I was only off by a factor of 10, right?
But yeah, I just wanted to make clear to the audience that donor advised funds are far and away the most popular philanthropic vehicle in the United States.
And so easy to use.
And easy, correct.
Yeah. Next slide, please. So now we're going to get a little bit into some of the tax benefits, looking at these organizations or types of vehicles side by side. So the first thing that we want to talk about is the annual deductibility limit generally. And here we're looking at under current law on the federal side with the existing Tax Cuts and Jobs Act rules that are in place through the end of 2025, because those rules include enhanced deductibility on the public charity side. So currently, for contributions of cash to a private foundation, this is where the first line and the fourth line sort of correspond with each other of this little chart. If you were to just donating cash, you could donate up to 30% of your adjusted gross income. And all of that would be deductible in the current year. To the extent that your contributions exceeded that, then you can carry forward the balance of that contribution for up to 5 years, and you can apply it against future income. With the supporting organization and the donor advised fund, you can actually contribute up to 60% of your adjusted gross income. So if you were only donating cash, you could donate up to 60% of your adjusted gross income, and all of it could be used this year as an income tax deduction. To the extent that you exceeded that, again, you would have a 5-year carry forward. So you'd have a total of 6 years within which to use the full deduction. Now, the other thing to note, and this is where it starts getting a little bit more important to look at the differences. On the second line, and then we're going to come back to the deductibility limits in a moment. But there on the second line, if you're contributing long-term appreciated publicly traded securities, so if you've got some long-held, Apple stock where there have been all these stock splits, or any security where there's been significant appreciation, you can donate those appreciated securities to the private foundation or to the supporting organization, and you get a full fair market value charitable deduction on the date of contribution for those assets. And once the organization receives them, and if they liquidate those securities at that point, they also get to avoid the gain on sale. So there's a double tax benefit there if you contribute those appreciated securities before they are sold, because the charity isn't going to pay income tax on the gain at sale, assuming that these were long-term appreciated assets. So for the private foundation, that deduction would be limited to 20% of adjusted gross income, Whereas for the supporting organization and the donor advised fund, because those are public charities, then it would be capped at 30% of AGI. So there's a 10% bump in terms of current year deductibility. The difference becomes even more acute in the third line. And I think this gets at one of the questions that we got in advance of the presentation. So if you have long-term appreciated assets that are closely held, for example, a closely held family business that's organized as a corporation or a partnership, a limited liability company that's taxed as a partnership, or real estate that you own directly. And if you were to contribute that to your charitable organization, if that contribution goes into a private foundation, your deduction is going to be limited to basis. So whatever your cost basis in the asset is at the time of contribution, that's the maximum deduction amount that you can get. So if you start, particularly if you're talking about, say, a real estate partnership, where one of the benefits of having that real estate partnership would have been the ability to take deductions over time, depreciation on the real estate investment, you might find yourself in a situation where you actually have zero basis in the property at the time of contribution. It doesn't matter if that piece of property is worth $25 million at the time of contribution. Your deduction, if you contribute it to your private foundation, would be zero. This is one of the reasons why when a client approaches us with an asset like that it would like to contribute, or say a company that they founded that's closely held where their basis is zero in the company, that's where we start looking at the possibility of contributing that asset instead to either a supporting organization or a donor advised fund. For a variety of reasons, donor advised funds aren't necessarily the prime entity to donate those to, and we'll get into some of those in a couple of slides. This is where often the conversation will start to turn to the supporting organization. Because with the supporting organization, if we can find the right organization to be affiliated with the supporting organization, you can donate that highly appreciated asset that you have zero basis in, and you get the full fair market value charitable deduction. And then if the asset is subsequently liquidated, again, depending on the nature of the asset, its tax status, et cetera, it may be possible that there's going to be no gain on the sale of that asset. So again, we're back in that double tax benefit situation that we talked about with the contribution of long-term appreciated publicly traded securities. So you can get a fair market value charitable deduction capped at 30% of your adjusted gross income, still having that 5-year carry forward as well. So 6 years within which to fully utilize the benefit. The one other thing I wanted to note on this is the notion of what we sometimes refer to as charitable stacking, which is the idea that, let's say you did have a 30% asset to contribute. Let's say you had a donor advised fund, since that's the most common, obviously, as Casey and I were discussing. So let's say that you had publicly traded securities to contribute to that donor advised fund, and you were interested in maximizing your charitable deduction. You could contribute publicly traded securities that have a value up to that 30% of your adjusted gross income, and then you could top that off with cash up to an additional 30% of your adjusted gross income, which would get you up to the full 60% deduction. And we see, for folks that are really charitably motivated, we see that as a strategy that they frequently employ. Next slide, please. Or Casey, did you have anything on that?
I did not.
Okay, next slide. So very quickly, on the tax efficiency for we were just talking about income taxes, now we're talking about estate taxes. With estate taxes, you have an unlimited estate tax charitable deduction regardless of whether we're talking about a private foundation, supporting organization, or donor advised fund. So if you're looking at primarily testamentary funding of the charitable vehicle and then leaving it to the next generation to do the charitable giving for you or for the family, then any of those structures can work. There are still some considerations to take into account, and we can talk about some of those, but at least from a tax deduction standpoint, it's going to be the same treatment. However, one thing I did want to point out is there is this recent tax court case, Estate of Miriam Warm, and this case is a great cautionary tale because in this particular circumstance, the estate plan involved charitable giving of an LLC that was 100% owned by the estate at the time of Mrs. Warren's death. And 25% of that LLC was going to go to a church, and the other 75% was going to go to the family foundation. The thing that was tricky about the case is that even though 100% of the asset was going to charity, because it went to two separate charities, the IRS applied discounting, and the tax court agreed. The same kind of discounting that some of you may have used in the estate planning context to take advantage of lack of marketability, lack of control, to transfer assets, say to trust for the benefit of your children or grandchildren, that same discounting, the IRS and the tax court agreed, should apply when the asset is going to charities, two separate charities. So because of the discounting that ultimately applied, there was a difference between the value of the asset in the estate, the 100% value, and the value of the deduction, because the church got 25% of the whole with a discount applied. And as you may be aware, these discounts can range anywhere from, say, 25% on the low end to 35% or more in some circumstances, depending on the asset and the structure. So it created this mismatch where the full benefit wasn't realized. How could this have been avoided? It could have been avoided by simply having the entire LLC contributed to the family foundation, and then having the family foundation make a contribution of 25% of the value to the church. So just a little cautionary tale there. All right, next slide, and back to you, Casey.
Great, thank you, John. So next we're going to transition into legal and compliance issues for each of these three types of entities that we're talking about. So since a private foundation and a supporting organization are both public charities, they can both be set up as either a nonprofit corporation or a trust. When we discuss establishing one of these types of entities with a client, there's several considerations that will help the clients think through. And one of them, it has to do with flexibility. So one of the things offered by a nonprofit corporation is that it offers greater flexibility to the members of the board of directors or the foundation managers under the applicable state nonprofit corporations law and the bylaws to change governance structure. And they can typically just do that by resolution. So as a private foundation or a supporting organization matures, oftentimes there's a need to change the governance structure, and there's the ability there to do that with a nonprofit corporation. The other thing that's possible typically with a nonprofit corporation is that the board of directors or I'll just say the foundation managers often have the ability to modify the purposes of the corporation. Depending though on the charitable trust rules of a particular state or any funds that may be subject to an endowment or restricted funds that can, draw AG attention, and it may be prohibited. But in the corporations code for a nonprofit corporation, there is typically the ability to modify the charitable purposes if need be. With respect to a trust, so the trust instrument offers less flexibility, and that may be something that is more attractive to the founders of the trust. It may be that the founders want the trust operated for very specific purposes, and they don't want future generations to be able to change that, or at least they want to limit the extent to which future generations can change those purposes. A trust instrument has to be irrevocable, and one of the issues that sometimes arises with a trust is that if the foundation's purposes, so if there's not the ability in the trust instrument for successor trustees to change the trust purposes, if those purposes become outdated or unworkable, it may be difficult, if not impossible, to modify the trust without having to go to court and seeking approval from the Attorney General. The trust terms can grant a trustee, broad flexibility. That's fine as well. But to amend the trust under most states' laws, it does require, if there's going to be a significant change of purpose after the founders are no longer around, will require a court proceeding, and typically the Attorney General in that state will have to be involved in order to change the trust purposes. The next thing that we look at after flexibility is the standard of care that applies. And for a nonprofit corporations, the directors of a nonprofit corporation, so typically they're subject to less personal liability than the trustees of a charitable trust. So trustees of a charitable trust are typically held to a higher standard than directors of a nonprofit corporation. Unrelated business taxable income. So this is another consideration that we need to make when deciding between whether to form the entity as a nonprofit corporation or a trust. So with respect to unrelated business tax or unrelated business income tax, so what this is referring to is a 501c3 organization is exempt from tax unless that 501c3 organization is engaged in a business activity that is unrelated to the organization's exempt purposes. And when that occurs, the unrelated business taxable income is subject to a tax. It's called unrelated business income tax, or UBIT. And that tax is imposed at regular corporate rates. So on a nonprofit corporation, it would be 21% of the unrelated business taxable income. Trusts are taxed at higher rates, so it's 37%. But if one of the things to take into account, if the trust or if the founders know that there is going to be unrelated business taxable income, oftentimes they will select a trust, because the trust can make a charitable contribution to another organization, and the trust will receive a deduction for that. And the deduction is up to 60% of the trust AGI for cash grants. And it's a way to basically offset the unrelated business income tax. Whereas with a corporation is limited to a deduction of 10% of its AGI. And so there's no way to significantly offset the unrelated business income tax there. So next slide, please. So I'm sorry, Pat, I forgot to have, I
wondered
go to
about
the next
that.
slide, please. I think I was one slide behind. I didn't have you advance to the
Okay.
next slide. I apologize. Okay, so with regard to a nonprofit corporation, what's involved in setting up a nonprofit corporation is filing articles of incorporation, preparing bylaws, and then preparing corporate policies. And so a nonprofit corporation is basically formed by preparing all three of these sets of documents. The articles of incorporation will include the name, the purposes, oftentimes the initial directors, and then all of the provisions that are required for exemption that we talked about at the beginning: the prohibition against private inurement, the prohibition against substantial lobbying, political activities, and it also has to include a dissolution clause. Articles of incorporation are filed with the Secretary of State, and the bylaws of a nonprofit corporation will include, it's basically sort of the governance rule book for the corporation. It'll include provisions addressing the board of directors, provisions including whether the organization has voting members or not, meeting procedures for the board of directors, and if it has members as well, provisions addressing the officers, indemnification, and other things. Some of the initial policies that a nonprofit corporation needs to have include a conflict of interest policy, expense reimbursement, document retention, so on and so forth. So next slide, please.
So in the interest of time, I'll just quickly touch on this. So as Casey alluded to, trusts are governed by a trust instrument. And that trust, so unlike a corporation where you've got articles and bylaws, typically the trust instrument itself will include all of the relevant provisions, both those charitable purposes as well as procedural matters like how are successor trustees going to be appointed? What flexibility do you have to express the purposes? And then the magic language, the 501c3 magic language that we've talked about that's required related to things like not being for the benefit of a private individual. All of that would be in the trust instrument itself. Next slide, please. So then we get to the exemption requirements. And with respect to private foundations and supporting organizations, as we mentioned, these are standalone organizations. So it's necessary to apply to the IRS for recognition that the organization is exempt from federal income tax. And then as part of that, the IRS will also identify the classification of the organization, whether it's a non-operating private foundation, as we discussed, or whether it's a supporting organization, if the governance is set up in such a way that the organization relates to another public charity. That will all be reflected in the IRS's determination letter. Then, depending on your state, it may be necessary to get a tax exemption from state law as well. Our state, California, requires this. And so we have a separate application process that we need to go through for the state of California. And then finally, depending on your state, it may be necessary to register with the state charity officials. Often this is the Attorney General, but not always. One state I'm aware of, it's the Department of Agriculture, oddly enough, that you do the registration with. So it's an additional compliance step that needs to be met. Next slide, please.
So there is one question from the registration I'd like to ask.
Yeah.
And it is, what is the best route to get started in separating operating business charitable giving from family-driven giving? Because I think that's a really good question.
If the business has done the charitable giving to this point, if the business does significant charitable giving, it is possible to form a private non-operating foundation that is affiliated with the business as a corporate foundation, where there would be a relationship between the leadership of the business and the foundation. Depending on the form of business, there could be certain deductibility limits that apply that may not make it the most attractive vehicle for doing the charitable giving. So, for example, if it is classified as a C Corp for federal tax purposes, in general, the deduction is going to be limited to 10% of taxable income versus for you and me, where we can get, as we were talking about, up to 30% of our adjusted gross income for contributions of publicly traded securities and other property, if we're talking about donations to a public charity, and an additional 30%, up to 60% of our adjusted gross income on the federal side for contributions of cash. So there's a lot more deductibility that we can have. So when you're at the stage of looking at how are we going to make this transition, what I have seen some families use with I think good success is maybe dipping their toe in the water, if you will, by starting with the donor advised fund, because it is so easy to get it set up, and to sort of approximate some of the governance that would normally be employed in the private foundation or the supporting organization. So, for example, having a periodic family meeting where you discuss what the charitable priorities are going to be, allowing each of the family members to have at least viewing privileges to see what's going on with the donor advised fund account, and perhaps to be able to make recommendations. Say in the case of the kids, I even have some clients who do this with their minor children, where they're able to make a recommendation, but the recommendation is still subject to mom and dad's final approval before the recommendation officially gets to the sponsoring organization. So there are ways to start building in those habits of charitable giving, and then either because of a particular transaction, say a big liquidity event with the business, and so the family is interested in donating a portion of their ownership, or simply because they want to step up the philanthropy, or perhaps because they have a family member who really wants to do philanthropy full time and be compensated for it. That's when we can start looking at some of the other structures, such as the private foundation or the supporting org. I don't know if you have additional thoughts, Casey.
Yeah, I was just going to add to your comments, John. You mentioned this at the first, but I mean, just thinking about the question, how to get started separating the operating business charitable giving from the family-driven giving, focusing more on the operating business charitable giving. You mentioned potentially forming a corporate foundation or a company foundation. So certainly that would be one way to create a separate charitable endeavor that's co-branded or affiliated with the business, versus the family that maybe owns the business.
Yeah, I was to say, I think some of it just comes down to ultimately what, say, you as the business owner or the founder, what you want the branding to be. Whether it ultimately is an affiliation with the family or an affiliation with the business.
Okay, I think our time is up, gentlemen. I'm sorry to say we didn't get to any of your questions, unfortunately.
We may need to do a round two, Pat.
Yeah, that's right. That's right. Just questions. And we don't have any in the chat. So I really appreciate this information. I found it very, very valuable, very interesting. I know everybody stayed on the call, so I know they did as well. So really appreciate your time today. Really appreciate all the work that you did in preparing for this webinar, and obviously for your presentation. So thank you so much. Hope you all have a great day. Take care.